Understanding your risk tolerance is crucial when building an investment portfolio that aligns with your financial goals and comfort level. The role of risk tolerance in building an investment portfolio explores how your ability and willingness to handle market fluctuations affect your investment choices. Risk tolerance is influenced by factors like age, financial situation, investment timeline, and emotional reactions to market downturns. Today, we will talk about the role of risk tolerance in building an investment portfolio. So before we start, make sure to hit the like button and subscribe to my channel. What is risk tolerance? Risk tolerance is essentially your comfort level with the possibility of losing money on your investments in exchange for the potential of achieving higher returns. It reflects how much market volatility you can handle before feeling compelled to sell your investments. There are three primary levels of risk tolerance: conservative, moderate, and aggressive. Each level affects the types of investments that are suitable for your portfolio. Conservative risk tolerance. Investors with a conservative risk tolerance prioritize the preservation of capital over high returns. They are often unwilling to endure significant fluctuations in their investment value and prefer low-risk investments, such as bonds, money market funds, or blue-chip stocks with a history of stability. The downside of this approach is that it typically results in lower potential returns over the long term. Moderate risk tolerance. A moderate risk tolerance strikes a balance between risk and reward. Investors in this category are willing to accept some volatility and short-term losses in exchange for the potential of moderate long-term growth. Their portfolios usually include a mix of stocks, bonds, and other investment vehicles that offer a blend of stability and growth. Aggressive risk tolerance. Investors with an aggressive risk tolerance are comfortable with significant market swings and are willing to take on high risk in pursuit of higher returns. Their portfolios are heavily weighted in equities and may include riskier assets, such as emerging markets, high-yield bonds, or sector-specific investments. This strategy can lead to substantial gains, but also carries the risk of considerable losses. Factors that influence risk tolerance. Risk tolerance is not a static measure. It can evolve over time based on various factors, including age, income, financial goals, investment experience, and psychological disposition. Let's explore these factors in detail. Age. Generally, younger investors have a higher risk tolerance compared to older investors. This is because they have a longer time horizon to recover from market downturns and can afford to take more risks to achieve higher returns. As individuals approach retirement, their risk tolerance tends to decrease, leading to a more conservative investment approach to preserve capital. Investment horizon. The length of time you plan to keep your money invested before you need to access it plays a crucial role in determining your risk tolerance. If you have a long investment horizon, you can afford to ride out market volatility, making it easier to take on riskier investments. Conversely, a short investment horizon requires a more conservative strategy to ensure the availability of funds when needed. Financial situation. Your income level, savings, and overall financial stability influence your risk tolerance. If you have a stable income, a well-funded emergency savings account, and few financial obligations, you may feel more comfortable taking on risk. However, if your financial situation is precarious, a conservative approach may be more suitable. Investment experience. Experienced investors tend to have a better understanding of market fluctuations and may be more comfortable with risk. Novice investors, on the other hand, may be more risk-averse due to a lack of familiarity with how markets behave. Education and experience can play a significant role in shaping risk tolerance. Psychological factors. Your emotional response to market fluctuations is a crucial aspect of risk tolerance. Some investors have a high emotional tolerance for risk and remain calm during market downturns, while others experience anxiety or stress when they see their portfolio value drop. Understanding your psychological makeup can help you build a portfolio that allows you to sleep well at night, even during market turbulence. The importance of assessing your risk tolerance. Assessing your risk tolerance is essential because it helps you build an investment portfolio that aligns with your comfort level and financial goals. Investing beyond your risk tolerance can lead to panic-driven decisions, such as selling assets at a loss during a market downturn. Conversely, being too conservative may result in missed opportunities for growth, especially over the long term. To accurately gauge your risk tolerance, consider taking a risk assessment quiz, consulting with a financial advisor, or reflecting on your past investment behavior and emotional responses to market volatility. How risk tolerance shapes your investment portfolio. Once you understand your risk tolerance, you can use it to guide the allocation of assets in your investment portfolio. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and cash, to balance risk and reward. Here's how different risk tolerance levels influence asset allocation. Conservative portfolio. A conservative portfolio may consist of 20 to 40% equities and 60 to 80% fixed income assets. The emphasis is on generating steady income and preserving capital. Investments may include high-quality government and corporate bonds, dividend-paying stocks, and money market funds. The goal is to minimize volatility while earning modest returns. The role of diversification in managing risk. Regardless of your risk tolerance, diversification is a key strategy for managing risk in your investment portfolio. Diversification involves spreading your investments across different asset classes, sectors, and geographical regions to reduce the impact of any single investment's poor performance. For example, even if you have a high risk tolerance and invest heavily in stocks, diversifying among various industries, such as technology, healthcare, and consumer goods, can help mitigate risk. Similarly, adding bonds or alternative investments to your portfolio can provide a safety net during market downturns. Adjusting your portfolio over time. Your risk tolerance may change over time, necessitating adjustments to your investment portfolio. Life events such as getting married, having children, buying a home, or nearing retirement can influence your willingness and ability to take on risk. It's important to review your portfolio regularly and make changes as needed to ensure it continues to align with your risk tolerance and financial objectives. A common strategy is to gradually shift from an aggressive to a conservative asset allocation as you age or as your investment goals evolve. The psychological aspect of risk tolerance. Understanding the psychological aspect of risk tolerance is crucial for long-term investment success. Emotional reactions to market volatility can lead to impulsive decisions, such as panic selling during a market crash or chasing after high returns during a bull market. To avoid these pitfalls, it's important to stay disciplined and stick to your investment plan, even during periods of market uncertainty. Working with a financial advisor or using automated investment platforms that focus on long-term strategies can help mitigate emotional biases. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.